Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Well, hello, and welcome to the COB on this Tuesday afternoon. It is the 23rd of June. I'm Nadine Blaney. Lovely to be here with you. Okay, so listen, today was one of those sessions up and down, seesawing all around, although quite pronounced selling as we move toward the close here in Sydney. I guess if misery loves company, we're not alone. Just check out the COB in Seoul. The COB has fallen about 6% as we continue to see tech getting sold off. And that's one of my key themes of this session. So a negative finish for the local market. Tech really weighing, not only here, but as I mentioned, overseas. We'll get there in just a moment. And as well, iron ore is coming under pressure, so a bit fraught, maybe that title should have been, for good old iron ore. Look, we had some news as well on SMSFs and their ability to purchase property using SMSF funds. So the Greens won the day on that one. But yeah, we've got iron ore down 12% in 6 weeks, and that is doing some damage to this local market. But let's look at the tech sector. Wisetech trading at levels not seen since 2021. Of course, real governance challenges there with the latest headlines around its founder, Richard White. But look, Wisetech isn't any better or worse off than the likes of Xero, which is also down by 5.5% to $65 per share. Technology One off by 7% to $27.73. Let's take a look at the miners. BHP, Rio Fortescue, South 32, and MinRes all pushing lower. As I mentioned, iron ore down about 12% in 6 weeks. So let's take a look at the energy space as well. Karoon is, well, one bright spot there. It's up by 1%. We've got the US waiving Iranian sanctions. Trump saying he will do what he has to if Tehran misbehaves, but yeah, lifting those sanctions on oil exports from Iran. All right, here's a look at these corporate stories. Wisetech says that its executive chair, Richard White, is not aware of any investigation into his conduct by the AFP. Reliance Worldwide will close its brass casting, forging, and machining operations at 2 Melbourne sites as part of a rationalisation of its global manufacturing footprint. Iluka Resources has secured its first rare earths offtake agreement with a global automotive company. And Viva Energy has dropped on an extended refinery unit outage in Geelong. And Metcash posts its worst day in over 6 months. UBS has cut its price target on those lower earnings that came through yesterday. Let's get a market view, shall we? Welcome back to the COB. George Baburas from K2 Asset Management in Melbourne. George, nice to see you. This time last week we were chatting in the wake of the RBA's interest rate decision was a hold. Tomorrow we've got inflation data out. That's going to be a big potential market mover.
Yeah, good afternoon. Good to be with you. Yes, tomorrow will be a big one. Noting that the headline's obviously going to be, it's a positive outcome. It's obviously excise duty being removed. Impacts of the headline, so it'll be lower than it otherwise would be in the core sense because of the cheaper energy prices on the tax. Having said all of that, generalisation, but global central banks are incrementally more hawkish, led by the Fed. You could sit there and say that the RBA is less hawkish, all things being equal, particularly with that commentary from the RBA governor. She was a little bit less hawkish in her description of it, looking at credit growth slowing and in part suggesting that they can even potentially in the scenario cut rates without the headline rate being within the target band. That sounds like the Treasurer has written the speech on behalf of the governor, but obviously they're independent, and it's a bit difficult to reconcile the logic of all of that. But Australia does have some issues there, but it feels like when you read that statement and reread it, it feels a little bit less hawkish relative to where they've been in the last 3-4 months. Having said all of that, the global cycle is what the one it dictates the most. Australian domestic demand is quite weak. Australian confidence is quite low, and obviously with these tax changes now going through the Senate with the Greens, the investors aren't really getting much of some good news when it comes to their investments and their savings.
It's pretty incredible the shift that's taken place as well when you consider expectations around the Fed. So a few weeks ago, market pricing in cuts coming from the Fed, but now it is pricing a hike in July. That is a very big narrative reversal in just a few weeks, George.
It is. I believe there won't be a hike, and I believe there won't be a hike this calendar year for the Federal Reserve. On hold seems to be the prudent policy. But having said all that, with Kevin Walsh been saying for some time, that's probably one of Trump's best picks. He understands the Federal Reserve, the mechanisms. He understands, obviously worked with Bernanke, the GFC, Janet Yellen, who went over to become a Treasury Secretary on the Democrat side. And he's worked through a lot of credit crunches, and he's obviously looking at how to make that Fed operate better and more efficiently going forward. So very good, positive first up. Obviously, it's a committee. He's got to influence people. But just to make it nice and clear, it'd be, I believe while the market is pricing that in, I don't think that will come through. But that depends on how you want to sort of reconcile how he talks about money supply going forward. But the inflation trajectory is not as bad as other developed markets, as again, my final point here, as verified through the inflation or the linkers or the break evens in the US.
So George, if you're an investor listening to this, watching this program, what are you doing in terms of asset allocation right now, given this inflationary environment that we're in, given the uncertainty around central bank moves, even if you don't think there's going to be a hike in the US, where are you allocating?
Yeah, so we are, with our growth and high growth funds, we are more global growth versus domestic growth. So that's more global equities versus Aussie equities. But let's cover it very quickly and reinforcing these points. With Aussie equities, it's really about the higher payout ratio, the income component, the income unit coming through at your highest tax. Obviously, in self-managed super fund or outside, it's obviously going to be taxed more. But nevertheless, we're looking at that income. Think of the banks as passing on some franking, some income, but very little upside of capital. With the very cyclical, we still like and looking as the market corrects, looking for exporters, so bulk commodities, metals and energy at a lower price. Export sector and entry points before the market or global growth is revised higher sometime in the second half of next year. So looking at that trajectory, but that volatility event will happen. But the thing to reinforce here is that domestic demand exposure in Australia quite weak for obvious reasons. Government policy hasn't helped the situation. So looking at the exporters and an opportunity. Very quickly, if we go around the world, we still like US equities. The concentration of the AI historical earnings growth and the capital that's been attracted from the equity and fixed income side is a little bit concerning, but just got to let that one play out, a bit more to come. But that means that there's other sectors within equities in the US and there's other parts of the fixed income opportunity in the US that are investment grade that have got good quality credit or in the equity sense expanding earnings to the lower price because the capital has been redirected into AI. So broader S&P 500 earnings outside of the AI seem to be quite reasonable. And my final point, if I may say, with the emerging market, be very wary. Like, for example, the COSPI's just been halted, suspended, down 8% this afternoon. But it's up 95% year to date. So that's been quite a volatile journey. The thing to reinforce with the emerging market index, it doesn't really make too much sense, but a lot of it up to 40% is AI, obviously because of Korea and Taiwan. So be wary of that. When looking to buy those earnings. And obviously, if you're buying index, you're getting that exposure. If you're buying active managers, you've got to see what they hold at the other end. Hopefully, there's a quick little wrap there. But looking, again, it's a global cycle for Australia. Sometime there'll be global growth revised higher sometime next year. And that's when the cyclicals, export sector-led resources, materials would do well.
Yeah, okay. And so you're not in any way calling this bubble territory, are you, George?
No, not calling it bubble territory. This is a historic time. Again, earnings, putting SpaceX aside on that multiple, the earnings have been met the multiples in check. Basically, the multiple is the same. SpaceX aside, the multiple is the same. The EPS, the denominator is increasing, and the numerator is there. I mean, have a look at like Nvidia. Its earnings over a number of years, it's up about 3-4 years. It's up about 12 to 15 times, and its multiple is the same. So that's quite reasonable. Earnings growing, price is the same. What it broadly means is that with the Magnificent Seven or parts of it, if it's an early sign that they believe there's no moat around those business models and someone else in the next 10 years can replicate it. But at the same time, it's not unreasonable. The earnings have been matched with the price. They haven't run away. Put again, disclaimer for the third time, putting SpaceX aside. So what I think what people are asking is, there's concentrations there, true. The earnings are explosive, that is true. The valuations aren't expensive because they've been matched, removing the recent listing again with Elon Musk. But it's that capital being redirected that's a bit of a concern. From other equity sectors and other fixed income sectors have been sold to participate in the all parts of the capital structure, that is the debt or the equity side of this intense capital appetite going forward. So not a bubble, again, putting SpaceX aside, because the multiple is basically being matched by this explosive earnings. But the key is, have they got a moat? Will they be replicated by other competitors? And people are saying possibly of the next decade.
Well, George, you've been very generous with your insights. Thank you so much for joining us today.
No, good afternoon. Good to be here.
George Baboris, K2 Asset Management. All right, our stock of the day today was Reliance Worldwide. Juliet Sally spoke with Andrew Coleman from Team Invest and Nathan Summerton-Darm from Deep Data Analytics.
Good business, Reliance Worldwide. Over the last 10 years, it's managed to grow sales from about just under 100 million up to just over $2 billion, and earnings from break even to around 200 million a year. Having said that, $100 million one-off charge, you could look at it one of two ways. You can either say, how did they let things get so bad? Or you can say, wonderful to management for having realised the problem and addressing it. But as a result, overall, I'd put this in the too hard basket. From our point of view as Team Invest members, Reliance Worldwide looks like a good company, but not good enough to be in our sort of top 20 or 30 that we want to hold.
It's running into inflation, cost pressures, as Andrew said. They're trying to rationalize. The model needs to be restructured. And it's just, construction slowdown is happening because of costs. And you can see it in the numbers out of China. There's just not happening around the world. So there's probably going to be a slowdown, and that's probably going to affect them. Sure, I don't see the catalyst in the short term for it to rebound. And this is kind of the part of the cycle where they'll be rationalizing, and that's exactly what they're doing.
All right, let's take a look at some of the leaders today on market. Telix Pharmaceuticals up by close to 3%, NRW Holdings, Chorus, Soul Pats, and Mesoblast. So a real motley crew there. Some of those that did lag the market overall. Iluka Resources, Technology One, Pantoro, Centuria Capital, and Domino's down to $15.96. Small end of the market now, please. And we've got Resource Minerals up by 18.18%. Ioneer also doing well, putting on close to 13% to 16 cents per share. Again, those that did underperform include Ecograph, CVC, Adson, Cobra, and Kelvo Rewards. Don't know that one. Off by close to 10%. So tonight, what's happening? Well, we get EU and the UK and US services and manufacturing PMIs. So lots of data to hang our hats on. We'll obviously be watching the political situation in the United Kingdom as well, and keeping a very close eye on any rhetoric coming from the Trump administration in relation to the Middle East. Of course, that is still very much a watching brief. We've got the US waiving sanctions on Iran for 60 days from Monday. First talks under this peace deal with the US President Donald Trump saying he will do what he has to do if Iran does not stick to its side of the agreement. All right, take a look at what we're expecting tomorrow. We touched upon it with George Baboris, my guest, just a short time ago. We get consumer price data, so inflation numbers for the month of May. Closely watched, obviously, for pretty obvious reasons as well. So we will cover that for you live when they drop at 11:30. All right, let's take another final look at this local market with the CBO Australia Index on your screen, finishing down by 0.4%. We are watching the S&P ASX 200 now that the last of the day's trades have gone through, also closing in negative territory. It down by 0.3%, 8,787. But yeah, big sell-off happening around the region, including the COB, and just keeping an eye on US futures. Negative with the NASDAQ off by 1.7%. Aluminium prices are falling. So again, we'll continue to keep our eye on all of those headline-driven events through the overnight period, and we'll tell you what they mean for your money when we're live again at 9:45 in the morning. See you then.